Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, once again, CDD is trading at 100.99. Option premiums are pricey, and we feel that the pair is going to be range-bound. The December 103 calls are bidding 68 cents. The December 99 puts are bidding 52 cents. Now, we could sell the 103 calls, collect $68 or 68 cents per contract. We can sell the 99 puts and collect 52, and our net credit is going to be $1.20. Now, our maximum risk in this scenario is unidentified, and that's an important consideration, because what that means is that because there's an identifiable risk exposure, most brokers are going to consider you having to put up a margin requirement. So in this case, the margin requirement for this strategy using Options Express's margin requirements is going to be $9,848. Now, this is going to vary, of course, from broker to broker, but the idea is that we're going to put up $9,848 to make $1.20 or $120. The risk-reward proposition here is a little skewed. The idea is that you would look at this particular strategy similar to how you would look at a covered call strategy. In other words, you're going to be long the cash, and you're going to write the option contracts as a way of generating some cash flow on your long cash position. So inevitably, you're going to be required to put up more capital from a margin perspective than what you're going to bring in for the credit. This is a great income-generating strategy. Now, we have to understand that there's going to be an upside break-even point. So in other words, if the pair value is anywhere below 104.20 on expiration, well, we're going to make some money on those options expiring or those options losing value. If the pair value is anywhere below the 97.80, we're going to in fact make money on those put options losing value and ultimately expiring worthless. If we take a look at the actual chart, what we're really suggesting here is that from now until the third Friday of December, we're actually looking at the CDD trading anywhere between 97.80 and 104.20. Okay, we would make money if the if the pair value settles anywhere between those particular levels between now and the third Friday at noon, mind you, of December. Now, we make maximum profits if the pair are both are trading sort of within. Let me just clear these annotations out, guys. Here, we're going to make maximum profits as long as the pair is trading below our written call options or above our written put options. So you can see here what we've done is we've ultimately created a scenario where we're capitalizing on the sale of expensive option contracts, looking for them to expire worthless, and collecting the premium. Now, for a lot of people, this particular strategy or this particular approach is a little scary simply because of the margin requirements. Now, that being said, we can actually look at creating a credit spread. So what this allows us to do is it allows us to be a net option writer, but we can identify our risk exposure. In this case, we believe that the pair is going to be neutral or range bound, and we want to be a seller, but the margin requirements are a bit of a deterrent. We're going to sell an option for a credit, but purchase a further out-of-the-money option contract to identify the risk and limit our margin requirements. So once again, if we look at the CDD as an example, we might be looking at the CDD trading at 101.50. The option premiums are pricey, and we feel that the pair is going to be range-bound. The December 100 strike puts are bidding 76 cents. The December 99 puts are bidding 49 cents. So in this case, we're going to sell the 100 strike put options, and we're going to collect $76 per contract. At the same time, we're going to buy those 99 strike puts, and we're going to collect $49. Our net credit is $27 per contract. Our maximum risk now is identified by looking at the difference between the spread, which is of course a dollar, and subtracting our credit, which is 27 cents. So our maximum risk is no longer unidentifiable. It's recognized as 73 cents per contract, or $73. Now, our margin requirement, because we've created this identifiable risk, is now only limited to $73 as well, because the broker recognizes that, hey, you know what, no matter how low the CDD drops, this gentleman has, or this person has the ability to buy it at 99. So even though there's an obligation to deliver at 100, there is a right to buy at 99, which means that that is the maximum risk exposure. Now, taking a look at our break-even points, we take our sold strike price, we subtract the credit received, and we get our break-even point. In this case, 100 minus 27 cents means our break-even point is 99.3. So let's take a look and see how it would look at our price chart. Now, the rationalization behind this from a technical perspective is, hey, the CDD has been trading at a support level of 100 for quite some time. Every time it's dropped down and hit 100, we've seen a bounce. So by process of elimination and by rationalizing this observation, we would expect that 100 strike put options are likely to expire worthless the third Friday of December, provided that the pair value remains above this particular level. Now, on the other hand, sorry, again, guys, the trade would be sell these 100 puts and buy these 99 puts. What this allows us to do is it allows us to collect a $27 premium, but at the same time, you can see that we've actually mitigated the actual margin requirement to the difference between the spread minus the credit we've received. Now, if we look at this from a profit-loss perspective, we put up 73 cents or $73 to make $27. That's about a 33% return on our position based on our risk-reward profile. Now, what this means is that we profit in full from as long as the pair value is trading anywhere above the sold strike. If it trades anywhere below the break-even point of 99.73, we risk losing money, but we can't lose any more than the purchase strike price we can't lose any more than the purchase strike price. So the difference between the sold strike and the purchase strike minus the premium we've collected is, in fact, our maximum risk exposure. Now, with this in mind, guys, what we can do is we can use the same outlook, and we can in fact create what's known as an iron condor. And an iron condor is simply looking at creating this what we would refer to as a bullish put spread. So by selling that put credit spread down here, we've created what's known as a bull put spread. Now, if we combine that with a bear call spread, which would have us, in this case, as you can see here, selling the 103 strike calls and buying the 104 strike calls, we're actually looking to capitalize on on the CDD remaining between 100 and 103. So in other words, we capitalize on the credit received here, we capitalize on the credit received here, and we've ultimately created we've ultimately created what's referred to as an iron condor. So as you can see here, what we can do by just being armed with some simple information, we can start putting this information together to capitalize on these expensive option contracts and our outlooks. Why would I look to sell these 103 strikes? Well, if I look back historically, that's been a very important resistance level.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.